A lot of retirees today are playing defense. They're holding more cash, they're moving into high yield savings accounts or other fixed income investments. They're pulling back from the stock market. And honestly, after all the volatility we've seen over the last few years, I understand. When you're retired, the goal and the game changes. You're no longer trying to hit home runs every time you step up to the plate. You're just trying not to strike out. But here's the problem. Many retirees have become so focused on losing less, they slowly start falling behind and they don't even realize it. I'm Jonathan Bednar, certified financial planner, owner of Paradigm Wealth Partners, and we help retirees plan for and execute a life that is filled with confidence and clarity in their retirement years. Right now, I'm seeing many retirees sitting on large amounts of idle cash, high yield savings accounts, money markets, treasury bills, fixed income investments that feel safe. And for the first time in years, those accounts are paying something. Over the last couple of years, you've been able to earn a decent return on your cash investments. Unlike the time period we saw from 2010 to 2020 or 21, that lost decade of interest rates when the Fed had a monetary policy at zero, it was almost impossible to earn anything on your cash. And so over the last 4 or 5 years, you've been able to earn something on your idle cash, and it feels really good. It feels safe, and it's become meaningful. So naturally, people feel safer there. They feel safer with that extra cash on the sidelines. But retirement isn't a 2 or 3 or 5 year plan. In many cases, it needs to last 25 or even 30 years. And over long periods of time, the inflation, one of the biggest risks to your retirement bucket or your retirement lifestyle, inflation, can quietly become one of the biggest threats to your purchasing power. Recently, the newest gauge of inflation came out, and the current inflation rate sits at 3.8%. At 3.8%, prices double roughly every 19 years. And so it sounds insignificant, not like a big deal, but silently it can deteriorate your retirement purchasing power. So the danger isn't usually in one bad year. The danger is slowly losing ground over time, over that 19, 20-year period. Healthcare costs rise, insurance rises, travel costs rises, groceries go up, your property taxes increase. And if too much money stays parked in ultra-conservative assets forever, retirees can unknowingly lose that future flexibility. I think this is where many people get stuck emotionally because cash feels safe. It feels comfortable and safe, and it feels like there's no risk. And sometimes what feels safe in the short term can create risk in the long term, especially if your retirement lasts longer than expected. We have clients living well into their 90s and hundreds, and so a lot of times people will tell us, well, I'm not going to live that long. Technology is getting better. Healthcare is getting better. What you have to do is make sure you've planned for the longevity and having your assets provide for your life expectancy and planning for that longer lifeline. So one of the biggest misconceptions about retirement, that is, everything should become more conservative. The older you get, the more conservative you should be. While there's merit to that, retirement still requires growth, not reckless growth, not meme stocks that have become popular over the last 4 or 5 years, not gambling, but a portion of your portfolio still needs to outpace inflation over time, because retirement isn't just about protecting money, it's about protecting your lifestyle. We need to make sure that we are able to pay our expenses, our living expenses, our health care, assisted living or home health care maybe in the future. All of those things need to be accounted for. And that's why we often talk about balance instead of extremes. Having safer assets for near-term income needs while still allowing long-term money the opportunity to grow and work for you. This is the reason we often structure retirement plans with multiple buckets. Maybe a short-term bucket for cash reserves. We call this the 6 months emergency fund. Maybe there's conservative fixed income investments. This is what we call the 5-year war chest. And then long-term growth investments. This is where we're going to get growth for your long-term needs and to help combat inflation. So the goal isn't to swing for the fences. The goal is creating enough stability so retirees don't feel forced to make emotional decisions during volatile time periods, while giving you a chance and the portfolio a chance to continue to grow over time. Retirement isn't just about avoiding losses. It's about maintaining your purchasing power, your flexibility, and your confidence for decades. Sometimes playing too much defense can quietly become its own risk. If you've enjoyed this video, please make sure to subscribe. I'll see you in the next video. Be confident in your retirement.